Beware of these market forecasters. This is going to be the year, or not the year. This is going to be the time we're going to get lots of forecasts. I'm going to do another video here in just a second, talk about my forecast. Oh man, but you guys got to beware because no one knows anything about nothing. That's all there is to it, man. But I thought it'd be fun to go back in time to 2000 and see what the market prognosticators were saying back then, and this will be fun. So anyway, I'm using my newspapers.com subscription. My newspapers.com, I pay $150 a year for, which is freaking fantastic. I love it. And we're going back in time to the AJC, the Atlanta Journal-Constitution. And we got two guys. This is Dateline 3 July 2000, which is a little bit belated relative because we already had a little bit of the market in March of 2000 began to retreat. We know that, but markets retreat all the time. So this was still the beginning of the market collapse that would happen over the next 3 years, going until March of 2003, by the way. But we have my man James Glassman, who had written a book called Dow 36,000, and he was the irrational, exuberant one. Then we had my man Robert Shiller, who had written a book called Irrational Exuberance, and that was published in March of 2000, so could not have timed that better. So this guy right here, Dow 36,000, could not have timed that worse. James Glassman, this guy right here, Shiller, Irrational Exuberance, published in March of 2000, could not have timed that better. There's so much more to the story here, which we'll dive into. All right, so let's read this here. We got pros and cons of Dow 36,000. According to James Glassman, this is a unique period in stock market history with a one-time upsurge in stock prices. Here are other arguments he makes about today's market. Stocks are no riskier long-term than treasury bonds. I cannot tell you how much I despise that. I've always have. I got the books on my shelf back there. Stocks, maybe you can see on this side. Maybe you can't. Stocks for the Long Run by Jeremy Siegel. I got 2 or 3 editions. It's such a fanciful way to look at your investments because the long term never comes. Someday never comes by CCR. It's the long term never comes. The long term, it's like chasing the dragon for you folks who follow the drug market. I just saw some flies, a piece of dust. It never hit. You're always in the short term. You're always a short term investor, always. Anyway, I hate it. I don't want to get too deep in that here today, but we'll do. I've done other videos. We'll come back to that again. Stock prices are low because how. Okay, I guess I can't highlight it. That's too bad. Can I? Nope. Stock prices are low because investors have judged them by past valuations rather than future profit and dividend growth. Does that remind you of anything today with certain stocks out there? Stock prices are low because investors have judged them by past valuation metrics, which are no longer should be believed. Valuation models, which are such as PE ratios and dividend yields, no longer reflect how investors behave and should be abandoned. All right, look, man, that whole valuations such as PE ratios and dividend yields no longer reflect how investors behave and should be abandoned. Stock prices are low because investors have judged them by past valuations rather than future profit and dividend growth. You see what's happening here? Glassman is making the greater fool theory. How investors behave is how I should dictate my own investment choices. That's freaking insane, man. So let's just look at one, for instance. We'll look at what are we going to look at? Let's look at old Tesla. Oh my goodness. I just, TSLA. Look, I get no qualm with Tesla. There you go. All right, and if you'll notice down here, if I can get my big fat finger, PE ratio, 1349, Tesla. 1349 is a PE ratio. Now we'll go back to what Amazon. All right, now Amazon PE ratio 95. Now, in the old days, everybody and their mom would say the PE ratio 95 is nosebleed. And I still say that. I still do today. Now, I remember when Amazon first turned a profit in 2016, and it also had a PE ratio like Tesla now, and like is 1,400 or something like that. And people were hoping that Amazon wouldn't have a profit because they didn't want people to see what the actual PE ratio was. I remember that. There was people arguing that Amazon should never have turned a profit because it showed how extraordinarily high the valuations were. Now we got a PE ratio of 95, all right? And so the naysayers were proven wrong, right? Because they say, look, was that 1,500? I bought it. I didn't buy it, but people did because they said it could go down to 95 PE ratio, which means the price went up significantly relative, and the profits went up along with the price. So it's a win-win. Well, it's still 95, still nosebleeder. And after this past crappy year, is there going to be any return to normalcy of PE ratio? I don't think so. Now, if you're a monopoly, you don't care about PE ratios. Monopolies always dominate. They have this moat called monopoly. Still, at the end of the day, the monopoly is only as good until the moat is breached, if that makes sense. So anyway, let's keep going. A stock's real value is how much money it will put in the investor's pocket long term. Again, I mean, all that stuff is along those same lines of the greater fool theory. The Dutch tulip. Hey, the value isn't the profits. The value isn't the dividend yields. The value is just what other people will pay for it. That's literally what this guy's saying here. It's crazy. Because how much you'll put in your long term is only contingent on what you can sell to somebody else for. Let's see. And by the way, don't forget, stock prices, PE ratios, and dividend yields have proven remarkable resilient in terms of defining stock market growth. That's just such a high correlation. There's no need to speculate on the internet stocks when plenty of established profitable stocks are undervalued. I agree with that. And everyone's saying, you could have been the next Amazon. Yeah, but for every next Amazon, there's 5,000 other stocks that were not the next Amazon. Only sell a stock if something important has happened to the company, such as a management or product failure. That's odd to me. Product failure? Do you sell the stock? Change in management. Despite the reasons for owning stocks, no portfolio is complete without some bonds and cash. And I cannot agree with that more. I think Glassman got raked over the coals as if he did not say you still need to be a diversified portfolio. I completely agree with that. And yet everyone and their mom hated Glassman. Dow 36,000, you're an idiot. And Glassman also was the libertarian side of things too. So people love to bash anyone who's not a statist. They love to bash. And so Glassman, Irving Fisher, they all said the good times are coming or are here to stay. And then when they got shown that wasn't true, that they're a little bit too quick on the trigger of good times, everyone hates on them. But for some reason, the negative Nellies out there of the world, they still get street cred. It's weird. If you predict chaos and you're wrong, no one hates on you. But if you predict good days and you're wrong, everyone, it's weird. It's just a tendency of human beings to just to be negative focused. No other way around that. All right, so let's read Schiller. Irrational exuberance. Schiller identifies 12 factors that have contributed to the self-fulfilling psychology of a roaring stock market. So here he's just saying why the market's up. The internet, the end of the Cold War and communism, cultural change favoring business success. I actually remember reading that in one of my economics class, where my man was talking about how business in the 80s became a high sought after degree, whereas it wasn't like that in the 70s. And his argument, my economics professor, is that structurally business gained traction, i.e. to be a capitalist, to make money became okay, whereas before that wasn't like that. And now it's right back to I'm a non-for-profit, as if that's somehow gives you some like, oh my goodness, you're non-for-profit, you must be righteous. I hate that crap. Being a for-profit company is always and everywhere a good thing. Being a non-for-profit, I'm going to tell you, man, you should avoid investing in non-for-profits. Those guys, they are profitable to themselves. They're not trying to make a profit. They're profitable to themselves, i.e. in a huge salary. Just look at all these freaking 501c3s. The CEOs are making bank, but they're non-for-profit. Republican Congress and capital gain tax cut helped pave the way for the stock market growth. I completely agree with that. Baby boomers' perceived effect on the market, expansion of media coverage of the market, Increasingly optimistic forecasts by financial analysts. Okay, I mean, we've had many years of increasingly optimistic forecasts, but that would go in the increasingly optimistic forecast. Abby Joseph Cohen and whatnot, and what was this, Henry Blodgett on top of the expansion media coverage. Expansion of 401k and other employee-owned or employee-directed pension plans, the growth of mutual funds, decline in inflation and fall of interest rates. That's a big one right there. The decline in inflation and fall of interest rates. Expansion of discount online and day stock trading. A relaxed attitude towards risk by the increase in gambling opportunities. All right, oh, that makes sense. But that doesn't say why he was irrationally exuberant or he was the market were irrationally exuberant. So here, we're just going to read part of the article. He predicts a long-term slump predicted. Whatever the explanation, Shiller has been taken more seriously than the Jeremiahs who typically emerge during bull markets and economic booms. For one thing, his academic credentials are impeccable, and his advice has been sought out by policymakers such as Greenspan. Shiller concedes he was probably the source of Greenspan's famous December 1996 comment about irrational exuberance, that investors were at least partly responsible for the extraordinary bull market. He had been one of a number of economists and market authorities invited by Greenspan to a private briefing just before the 1996 speech. And he laid out a grimly bearish scenario of the future based on his analysis, which obviously impressed Greenspan. At any rate, he decided to adopt the term as the title of his book. The nucleus of his argument is that stocks are overpriced to the greatest extent in history. And based on what happened to the market following past periods of extreme overvaluation, investors face a prolonged period of meager returns. Many years worth. Okay, so many years worth. He used the most common measure of stock valuation, his PE ratio, is expressed as a terms of a multiple of the company's per share profit and represent what an investor is willing to pay for a dollar of earnings, or rather the investor's expectation of future earnings. Historically, investors have paid an average of $15 for $1 of earnings. Today, they pay almost $30 for each $1 in profit, and sometimes more. High multiples are not necessarily bad. So-called growth stocks have always had high multiples. It's extraordinarily high multiples beyond any expectation of future profit growth that's said to be dangerous, making a stock vulnerable to a sell-off in a weak market. He noticed that the multiple for the S&P 500 has been low as 5. In the post-World War I recession, the index was at 32.6 in September 29, and then just as the Great Crash in October of 1987 is at 20. He noticed that 3 previous periods of extraordinary high PEs after which stock market returns diminished for extended periods. The market lost 67% of its value in the 20 years following the turn-of-century peak in 1901, with stock returns dropping to a negative 2% per year over the next 20 years. The S&P lost 80% of its value from 1929 to 1932 and posted average annual returns of only 0.4% in the following 20 years. The 60s bull market, when the index reached 24.11 in January 1966, the real return, that's net of inflation, was only 2% over the next 20 years. And based on that record, Shiller contended that today's investors can look forward to many years of minimal stock returns since the market is more overvalued than ever. He thinks something will trigger a 1987 style crash or more likely a prolonged 1970s bear market. So he's vacillating there, saying it could be a huge crash in one fell swoop or, a la March of this past year, 2020, or a prolonged bear market. Well, can't make his mind. He doesn't make a specific forecast because he can't predict short-term moves. It doesn't help. Shiller believes that investors are prone to irrational behavior, contrary to traditional market theory. He takes issue with the random walk. Let's see here. Hold on a second. He takes issue with the distinction between the behavior of individual and institutional investors. Institutional investors know how to read balance sheet, but they tend to tell everybody what they know, so they don't have any secrets. I agree with that. He criticizes the efficient market theory of Burton Malkiel, the random walk down Wall Street, which are based on the ideas that stocks are always accurately priced because of all the information is known already. I agree with that. because all the information that is known is relative to the people buying the shares. Now, they're not going to have some fundamental change in knowledge. They're going to have some fundamental change in risk. But we don't know what that change is right now. The market is high because of the combined effect of indifferent things. All right, whatever. He cites the market excess volatility as evidence of irrationality, characterized by sharp increases followed by dramatic falls on little, if any, obvious news for logical reasons. He argues that at those times, investors buy or sell not for any rational reason, but because other investors are buying and selling. One of Shiller's key critiques of the buy and hold philosophy, possibly the most frequent advice offered investors, is based on the fact that stocks outperform bonds over the long term. He cites the 10-year periods after the market peaks in 1929 and 1966 when bond returns exceeded stocks. He gets criticized, though. All right. Anyone who followed this advice 3 to 4 years ago when he was initially telling Greenspan about irrational exuberance would have missed the extraordinary run-up from stock prices from 1996. Barron's economist Gene Epstein accused Shiller of exaggerating current PE ratios by using the 10-year, that's the beginning of the CAPE, cyclically adjusted price-earnings ratio, which missed the big earnings surges in the recent years. Shiller responded as analysts' analysis fairly represent for the PE for the entire time. The interesting thing is that Shiller has since had to reclaim the CAPE by basically saying it's because of interest rates being so low that the market is okay. But that I did a video on that not too long ago. But his friend, Yardini, and others, some economists say the stocks are not as overvalued as Shiller contends based on projected earnings. Well, that's the problem. Projections are only good as the projections until they're actually sewn in the balance sheet. It's only projections. So Shiller hasn't had any investments in stocks at all. He was completely out of the market during this time. So that might look good. So I want to go into, let's do part 2 of this video, because I want to share with you what you would have missed if you followed Shiller from the time he was talking about irrational exuberance in 1996. Well, actually 1995 going into 96. So stay tuned for part 2.